Ladies and gentlemen, good day and welcome to the Shri Keshav Cements and Infra Limited Q2 and H1 FY26 Results Earnings Conference Call hosted by Kiran Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshal Ghanshani from Kiran Advisors. Thank you and over to you, sir.
Yes, thank you. Good afternoon, everyone. On behalf of Kiran Advisors, I welcome you all on the conference call of Shri Keshav Cement and Infra Limited for Q2 and H1 FY26. From the management team, we have Mr. Venkatesh Katwa, Chairman, Mr. Vilas Katwa, Managing Director. Now, I'll hand over the call to Mr. Venkatesh, sir, for the opening remarks. Over to you, sir.
Yeah, good afternoon, everyone, and welcome to Shri Keshav Cement and Infra Limited Q2 and H1 FY26 earning call. I sincerely appreciate your time and interest in joining us today. Shri Keshav Cement and Infra Limited, formerly known as Katwa Udyog Limited, is engaged in the manufacture of cement and generation and distribution of solar power in Karnataka. Our cement plants operate from Bagalkot district, supported by 40 megawatt of solar facility in Koppal, both in North Karnataka, which enables us to run entirely on green energy. We serve North Karnataka, Coastal Karnataka, Goa and parts of Maharashtra through 350 distributors and over 600 retail touchpoints and 14 solar power consumers. Before I move to present the company's financial performance, let me briefly share our strategic progress. With the new kiln stabilized and contributing consistently, our focus has shifted towards strengthening market penetration and improving our reach across key regions. We are working on expanding volumes, improving supply chain efficiencies, and ensuring better product availability across channels. Our fully renewable energy-backed operations continue to provide us with a strong cost advantage, helping us remain competitive even in a dynamic pricing environment. These efforts position us well to capitalize on ongoing demand from infrastructure, housing, and commercial construction across our core markets. So let me walk you through the financial performance for Q2 and H1 FY26. In Q2 FY26, the company delivered strong top-line growth with a total income of 36.22 crores, rising around 42.81 year-on-year, supported by better realization and higher cement dispatches. EBITDA for the quarter stood at 8.38 crores with a growth of 175%, and EBITDA margin improved to 23.65% compared to 12.44% in Q2 FY25, reflecting a sharp expansion of 1,122 basis points. Q2 PAT was 0.69 crores, marking a clear turnaround from last year's loss, while EPS improved to 0.39 from a negative base. For H1 FY26, the total income increased 37.14% year-on-year to 77.62 crores, and EBITDA stood at 18.7 crores, growing at 69%, delivering a healthy margin of 24.68%, reflecting a sharp expansion of 444 basis points. PAT for the half year was 3.78 crores and EPS improved to 2.16 crores, 2.16, reflecting strong utilization, cost efficiencies, and improved operational performance through the first 6 months of the year. Cement remained the strongest contributor to our performance, both in terms of revenue and profitability. Higher dispatches, improved realization, and the consistent running of the new kiln have strengthened the segment's momentum through the quarter. With construction activity remaining steady across Karnataka, Goa, and Maharashtra, our focus is on leveraging this demand through deeper market engagement, stronger leadership, and better availability of our key brands. Cement will continue to anchor our growth, and we aim to build further on this trend in the coming quarters. Looking ahead to the second half of FY26, we will continue to prioritize disciplined execution, efficient utilization of assets, and deeper engagement across our dealer and retailer network. Our aim is to maintain consistency in operations, strengthen our market position, and build on the momentum achieved so far. With steady cement demand across our regions and cost stability offered by solar power, we believe we are well placed to drive a sustainable performance. So before moving on to the QA session, I really extend my sincere thanks to all the stakeholders, partners, customers, and employees for their continued support and confidence in the company. Their contribution remains central to our progress. With this, I am pleased to open the floor for questions. Thank you once again for being with us today. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ishita Sen from Urban Sphere Consultancy. Please go ahead.
Yeah, am I audible?
Yes.
Yeah, so thank you, sir, for giving me this opportunity. So, your presence is strong in North Karnataka and Goa. Which new markets, like example Pune, Bangalore, Kerala, are you planning to enter post-coast optimization?
So the plan right now is we are focusing on North Karnataka and South Maharashtra, but due to turbulent prices in cement industry, we are not going farther than about 200 to 250 kilometers. As such, right now our focus is in South Maharashtra, North Karnataka, and Goa. We are looking at non-trade customers, which we are steadily developing. And recently we have got approval from various departments, and we would look into developing those areas currently. For now, Pune and Bangalore, we will be holding it up for some more time till there is a general improvement in the pricing.
Okay, sir. So, like finance cost has remained elevated. How do you plan to reduce debt post full commissioning of expanded capacity?
So once we start catching up with the rated capacity, for example, we are still in the range of 35 to 36% capacity utilization. That is, once our plant was stabilized, the market has been a little slow. So once that picks up, any cash accrual will go towards, using towards reducing the debt.
Okay, so like your fuel and power expenses are expected to fall significantly post-expansion. Like what is the current cost MT versus the targeted cost MT after PH cyclones, VRM and calciner upgrades?
So, in the kind of reporting that we have done, we have not shown fuel and electricity as a different cost. However, I can give a general comment stating that our electricity cost is going to be lowest in the country because entirely the production is done by renewable power, and the cost of power based on O&M expenses almost 20-25 paise per unit. However, the fuel cost, what is expected to reduce, is showing great progress in reaching what we had earlier planned. So, for example, before CAPEX, our fuel consumption was extremely high, almost to reaching 1200 kilocalories. So we have to reach below 800 kilocalories, and we are reaching almost 850 to 900 right now. So it might take another couple of months before we reach that level. As such, today with the kind of fuel cost, we are very, very close to the industry majors.
Okay. So yeah, thanks sir, for answering my questions. That's all from my side. Thank you so much.
Thank you, madam.
Thank you. The next question comes from the line of Aditi Roy from Patel Advisors Private Limited. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon, Aditi.
My question is, how much incremental volume did the new crane contributed in Q2 FY26, and what is your expected monthly run rate now that stabilization is completed?
I could not get the first part of question. Can you just repeat the entire question again?
Yeah, sure, sir. How much incremental volume did the new crane contributed in Q2 FY26?
Sure. So for that part of the question, the incremental volume was 52% year on year. So we have been improving on our volume significantly year on year, be it first quarter, second quarter, and H1 levels. So that only thing, since we have increased the capacity by 3 times, the top line will start showing once we reach at least 50 to 60% of our capacity utilization. So for the question that you asked, the incremental volume was around 52 to 53% compared to Q2 of FY25.
Okay, sir. And my next question is, have you started seeing any measurable improvements in heat efficiency after installing the new PH cyclone?
Okay, I think I'm missing the question here. You mentioned cyclone, right? What kind of cyclone are you mentioning?
New PH.
Oh, yes. With the new preheater equipment that we have put in, it's the most advanced one with the current technology. Of course, with that, we are expecting the fuel consumption to reduce, which it has reduced considerably now. So marginal reduction is expected, maybe this quarter, and we will reach to almost one of the most efficient plants by the end of this quarter.
Okay, sir. And sir, what were the average cement realization in Q2 FY26? And how do they compare with Q1 FY26?
So the rates have been pretty much flat. For example, in Q1 FY26, the naked cement price was around 3,430, and in Q2 it is 3,460. There is a slight dip in volumes, which is very cyclical and related to monsoon, which is typically seen in all the cement plants. But otherwise, our EBITDA per metric ton has gone up for cement. It used to be negative in Q2 FY25. It has become positive to 350 rupees per metric ton.
Okay, sir. And I have one last question. You reported a better operational efficiency in H1 FY26. So what specific cost items that saw the highest reduction in Q2?
So typically with the increase in the volumes, the fixed costs remain relatively the same. Plus there was a reduction in the fuel cost and also, some other fixed costs which is associated with the increased capacity, which is why you would see the better operational efficiency, and continue going forward, you will always going to see improved operational efficiency since the new plant has been developed, which is giving us high efficiency in power and fuel.
Okay, sir. Thank you, sir. Thank you from my side. All the best, sir.
Thank you.
Thank you. The next question comes from the line of Ratan Shah from MMTC. Please go ahead.
Hello. Am I audible?
Yes, Ratan, you are audible. Please go ahead.
Yes. Thank you. And good afternoon first. My first question is, what steps are you taking to strengthen the dealers' loyalty and expand the retail footprints beyond, your current 600 plus touch points?
So basically, currently, of course, even though quarter 2, as you see, has given very good results compared to quarter 2 of FY25, I wouldn't still think that the pricing was very, very encouraging compared to what we have seen about 2 years back. But coming to your question regarding how are we going to improve the retailer loyalty to the company is working on some digital marketing, also reaching out to the decision makers like engineers and everyone else. Plus, there is a new loyalty program which the company is willing to be launching very soon, wherein there are some retail marketing hacks the company is going to use to encourage the end user to buy Keshav cement or Jyoti cement, which is our brand. And on the top of it, we are also making sure our dealers to stay loyal. We are trying to give the best possible services. And the best thing what we can do in our plant is, which is very well known in the market, is that we have a very good supply chain by which once there is a requirement, we typically deliver it in less than 12 hours or so. So yeah, I mean, with that, our dealers have remained extremely, very high fidelity with us. It is just that the local offtake of cement has reduced because of very less consumption, because of significant monsoons and, a lot of labor's unavailability due to elections in Bihar and many other reasons. So once that starts reversing, the same dealers who are buying less than 50% compared to the regular buy what they did last year will again regain to full 100%, and that will show the improvement in sales.
Okay. And since your working capital requirements are generally increased with higher volumes, so has your working capital cycle stretched in Q2?
Not significant. The inventory days have, of course, gone a little higher, and also the receivables have gone out from 14 days to 18 days. Otherwise, we have increased our working capital limits, but there's not significant change compared to Q2 of last year.
Okay. And how have your logistics cost trended in Q2? And do you expect any improvement in cost economics once the plant operates at higher utilization?
So logistic cost will not have any impact on economies of scale. Typically, I would be paying the same cost per kilometer or per beam compared to all the major plants, because logistics is operated by typically very small firms or the owners of the truck, which becomes very same to everyone. There is absolutely no economies of scale benefit with the logistics.
Okay. And with VRM and Concall upgrade coming online, what's the improvement in clinker factors are you targeting over next 12 months?
So based on our planning, whatever we had expected, improvement in quality and reduction in fuel consumption, reduction in power consumption, to a large quality has of course improved drastically, but then fuel savings has improved by over 80-85%. Balance 15% will cover it in this quarter. Fuel consumption has reduced by about power consumption per unit has reduced by almost 20-25%. And there is a scope for reduction of another 5-6%, which we will most likely achieve this quarter. So we have achieved all those key performance indicators that was planned base, which was an objective to set up go for this brownfield capex.
Okay. And my last question is, what proportion of the cement sales in Q2 came blended cement or OPC? Do you foresee a mix shift in H2?
We are actually focusing on blended cement because that's where we tend to get the highest margin. We have, of course, we also have 43 grade, 53 grade cement to sell. Generally, it is not on a very regular basis, but whenever there is a requirement, we have we have the machinery to deliver any type of cement within instance of 1 hour. We can deliver any type of cement. So with this new capex, we have made sure that we are capable of delivering any kind of cement at any given point in time.
Okay. Fine. That's it from my side for now.
Yes. Thank you, sir.
Thank you.
Thank you. The next question comes from the line of Manan Vandur from Wallford PMS. Please go ahead.
Yes, thank you so much for the opportunity. Sir, I've been tracking your company for the past 2 years, and it is really joyful to see how the company has turned out to do, all what it had committed. So really congratulations on the full team for that.
Thank you, Manan.
Yes. So I have 2-3 questions. First question would be, sir, if I want to check and track the cement prices, where can I track the cement prices? Like what software I can use or what website I can use to check the cement prices so that, I can do my calculations on the company.
Sure, Manan. So I can tell you this question was asked, I think, a couple of times in last couple of years or so. Now, if you look at various reports on cement, you will see that the cement prices are in the range of 375, 380, 400 or 450. Now, cement is a bulk product, which means that the logistic costs weigh very heavily.
Okay.
Now, with the new GST regime, what typically happens is, for example, now when we talk about naked cement price or naked cement rate, that was a word which was very commonly used in cement industry, which is no longer used because that was revealing too much information to the competitors. Now, naked cement price is something which said what was the price at which you were selling, excluding logistics, taxes and everything just outside your gate, just the naked cement cost. But then now what is happening is the general term uses cement realization. Now, cement realization would mean that it is a first point building from the company to the outside world. And a lot of times what happens is the larger plants, they transfer the cement from their plant to maybe a grinding unit and then grinding unit to the godowns. So from godowns, it becomes the first point of sale. So then, they work on those kind of cement realizations. So generally, even a person like me is finding it difficult to find that kind of information. For us, the only source right now is some of our dealers who also sell other brands. From there, we get most accurate information. Otherwise, now available data is with Cement Manufacturer Association. I think if you're an analyst, they might give membership and, you will have monthly data on dispatches as well as the price movement from them. Other than that, available in the free world, it is difficult to find out the movement of prices and dispatches.
Okay. Yes, that was very helpful. So my second question would be, sir, what was our EBITDA per ton in this quarter?
So EBITDA per ton,
other quarters also, like this quarter, comparing in last quarter, H1, something like that.
Sure. So in my hand, I have something which I could. So for Q2 FY25, it was actually minus 579. Q2 FY25 is one of the worst quarters, and the entire year for FY25, the EBITDA is less than 50 rupees per ton. But then because then our new kiln came into existence, we commissioned it. So in Q1 of FY26, the EBITDA went up to 364, and FY26 Q2, the EBITDA is around 352 rupees. Now, I would like to add some information here. If you look at the national level, if you look at north, west, and center, their EBITDAs are between 900 to 1,000 rupees. If you look at the EBITDA of the area of cement plants around mine, very specifically in my area, they're less than 300 rupees. For obvious reasons, I cannot give the names, but you can always find out online by looking at the plants who are very specifically located in the belt what we are operating. Now, these EBITDA margins I'm talking about is again excluding the benefit of solar. So again, when we talk about EBITDA per ton, northern plants, when they show 900 rupees EBITDA per ton, but that is because of waste heat recovery system what they are used. Now, if I include my solar benefits in this EBITDA, then my EBITDA is in the range of 1,130 rupees per ton. So I don't know how you're going to make a proper comparison. Since we are the only cement plant in the country to run on 100% solar power, sometimes I feel apple-to-apple comparison will be little oblique, yeah.
Right. Okay, no, this was helpful. With the comparison with other companies, it was helpful. Then, sir, last question would be about for the production and sales figures, sir. Just like how you gave for Q2, Q1, H1, etc., like that, please.
Sure. So I'll give information on two things. One is on the volume. So Q2 FY25, the volume was around 51,600 tons, and Q1 FY26 volume was 89,000 tons, and FY26 Q2, what we are discussing about, the volume is 78,995 or about 79,000 tons. These are the volumes. The volumes increased by around 53%. In fact, my only cement division sale increased by 64% because for a very, very strong marketing push, in spite of South showing almost 0% growth, year-on-year growth on cement dispatches, we pushed it to 53%. So had there been a little push in the market, we would have reached almost 100%. But the important point to mention over here is the fuel price, which was around 11,700 rupees in Q2 FY25. It reached 12,130 in Q1 FY26, and now it reached 13,100 in Q2 FY26. So there has been a steady increase in the fuel price. It appears that Q3 there has been some reduction in the price, but that benefit we will see in Q3 results itself.
Okay. So, sir, these figures that you gave were production, they were sales figure, right?
Yes. So production figures and sales figures wouldn't differentiate much because generally any cement plant of holding capacities for less than half a day or 1 day of production.
Okay, understood. So majority it is same, the production and sale is almost same.
Yeah, more or less. Plus or minus 500 here and there, you will have the production.
Okay, understood. Sir, thank you. This was very helpful. Thank you so much, sir.
Thanks a lot, madam. Yeah.
Thank you. The next question comes from the line of Bharat Gupta from Fair Value Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Couple of questions, sir. So first, with respect to the institutional mix, I think in the last phone call you mentioned of prioritizing the institutional mix on our cement division. How has been the progress in regard to it, and how do you see the demand overall with respect to Q3?
So yes, there has been a strong push on institutional side. Even though we have got firm orders based on the EMDs that we submitted, the offtake was not very significant from them because of their low usage. It is not that we lost our volumes to some other company. The total offtake itself was extremely low, in spite of them giving us a high value purchase order. Mainly because from their instance, the construction activity within the state was a little slow, and then we had this, apart from Diwali and Dussehra, a lot of workers who were supposed to be, in part of this construction industry were not available. They had gone to different states where there was elections and other festivities, which is why generally Q2 volumes have been very, very difficult for cement industry. In our case, very likewise, we were targeting almost 80 to 100% increase in sales in volume, but then because of all these factors, we had to console ourselves with 53% growth. But for the question that you're asking, yes, there is going to be an institutional and the regular mix, and company is focusing. We have got clearances and acceptance from many new PWDs in South Karnataka, South Maharashtra, North Karnataka. And, as we move along, we'll continue to pursue them and, improve our penetration in those sectors.
Right. So given, like you mentioned, that your EBITDA per ton for the quarter stood at near about 364 rupees, I think with respect to 50% utilization, which we aim to achieve during this fiscal year, what kind of EBITDA per ton are we looking at?
Now, assuming that price remains typically the same and is not significantly improved, so H2 should show a better EBITDA because our kiln has stabilized even further. Like what I have been discussing, our EBITDA is going to be in the similar range of what other major plants are going to be having in very specifically in the south. So if prices do not move, they remain as it is, then EBITDA range is going to be between 350 to 450 rupees. And, because the prices itself decide what EBITDA margins we're going to get. However, it is an expectation that the prices and the, constructions should start improving by the end of this November, but we will have to wait till it actually happens.
And so in regard to it, if the price remains on the current levels, I think previously we stated a EBITDA guidance of somewhere close to 65-70 odd crores. That remains on cards, or we see a downward revision to it?
Now, typically H2 contributes to 60% of the sales, and last 2-3 years, all the cement plants, they go by similar phase. H1 contributes to 41-42% of the sales, and H2 contributes to 58% to 60% of the sales. If that stays online, then our EBITDA is going to be between 45 to 50 crores. I wouldn't say 60 crores with these kind of pricing. That is very, very high. We have a very high fidelity with the pricing itself, and particularly in the region what we are selling, there has been a significant and turbulent pricing for cement, as a product.
Right. And sir, with respect to continuing on the industry mix side, so given forward, with respect to achieving a 70% utilization rate for the next year, do you think there will be a good amount of revenues which will be coming in probably next year from the institution clients?
Yes, I hope so. I mean, with the way things are going right now, Q2, basically Q1, Q2, the monsoon started very early, which is why Q2 and Q1 partly suffered. Now, assuming that the construction work, the pent-up demand should come up, if that happens, yes, we should be able to reach, because our quantity of 1 million ton is very, very insignificant. In the areas that we sell, the total quantity requirement is around 30 million tons, whereas we sell only 1 million ton. So having said that, even a little pull in the market, like I did answer in the previous question, some of our existing retailers and the registered dealers are selling less than 50% of what they sold last year. In spite of them, we have increased the sales solely because we added new customers, new institutional buyers, improved on our geographical area. Within this geographical area, if there is a little, pull in the market, we should be easily able to sell 60 to 70% or even 80% without much, without much difficulty. Because the area what we have covered is very, very significant now.
Right. Secondly, sir, with respect to the RMC, I think we were doing a pilot phase for it. What has been the progress, and when do we see a commencement with respect to starting off with the production on the RMC side?
So RMC, basically the management was thinking of beginning to have a pilot in Q3 itself, but we will have to postpone it till we make sure cement is firmly stabilized. It was very expected that cement price will improve this quarter, and then once that is done, it would really make sense for us to move towards RMC. So as of now, we are still looking at by end of Q3, end of Q4 is the region, or Q1 of next year is a tentative time when we will work on setting up. Setting up an RMC is pretty fast. Typically takes about 45 days to 60 days, and it's not very capital intensive either. So we are just waiting for cement to stabilize to the level what we have projected, and then it would definitely make sense for us to move to RMC. But RMC we will definitely go because we have already invested in the land. All the clearance regarding the land has been received from the government. To anything and everything that needs to be regulatory clearance, we have received it. Only thing we have to look at is invest and move forward on that.
Right. And sir, any particular capex for this year, with respect to solar?
No capex has been planned immediately. There are plans going on about solar and other things, but nothing has been materialized to a point where you could expect any kind of capex coming up.
Right. Just a last question, sir. In regard to FY27, assuming we operate at 70% utilization levels, what kind of a EBITDA per ton we can probably achieve given out the operating leverage advantage which we will be getting, and what kind of a EBITDA numbers you probably will be looking at, assuming the prices remain stable at the current levels?
See, at the current levels, at 70%, our EBITDA should easily cross about total EBITDA on the cement plant, including solar, should cross 70 crores, 70 to 80 crores, because if the price remain, which itself is not a very good pricing, I would assume 70 to 75 crores should not be a very difficult target.
Right. And the price
for the whole, go ahead.
The current cement prices in your region, that is how much below the 5-year average?
So I would say on a CAGR level, it is almost 0% for last 5 years. In fact, FY23, we had a better pricing compared to FY26 now. So FY23, FY24 pricing was almost at 4,100 levels when our, the fuel cost was also less. So now the EBITDA is now the pricing, naked cement pricing is 3,460 for Q2, which is, of course, we're losing about 600 rupees in EBITDA over there.
Right, sir. Right. But any anticipation of a pricing hike coming in place, given out the monsoons are over now and there will be a push from the government side also. So do we see some sort of an improvement in the pricing coming in place for the S2?
So last 3 years data, when you look at the price increase has happened in the last week of November. If the data and the historical, it remains, then the last week of November should be the time when the price increase starts, all the way till the end of May or till the monsoon begins. But, all that we need is the beginning of a construction work. The moment is the first beginning of a sudden construction improvement, everyone will, come with the acceptable pricing.
Right, sir. And with the current distributor base itself, we will be able to achieve that kind of EBITDA numbers which you have forecasted for FY27.
Absolutely. That's what I'm saying. In fact, one of the reasons why we increased our sales compared to Q2 of FY25 year on year is because we have added a new geographical area, we have added new customers, we have added new institutional buyers. The only reason we are not able to fully achieve our projected is because the existing dealers itself are buying less than 50% of what in the last 5 years they were buying with that trajectory. So that is mainly because there is a significant downfall in the offtake. And that has to change. It is not that we will lose it out. It is just that because monsoon started earlier and then there was, like mentioned earlier, the construction workers had to leave because of festivals and then elections and stuff like that. That is a general indication what we see from the cement analyst. So once that gets corrected, it should be very obvious that it is going to be a benefit to cement.
Right, sir. Just sorry to squeeze in one question. With respect to the mixed cement prices, how competitive are we with respect to our peers? I think Dalmia and JK both have plants out there in the region. So what kind of benefit they enjoy over us because they have their backward integrated limestone capabilities as well?
So they have economies of scale, one big advantage. But the kind of advantage we have with renewable power, they don't have it. And that's very, very significant. Even higher than any difference you would get having a captive mines. So yes, captive mines does give you a savings of about 3 to 4, almost 4 to 5% on the entire cement production cost. But then the solar what we're getting is even more higher. So other than economies of scale and a good brand image and a name, I think we are almost at par with such brands. In fact, some of the customers who are buying their brand, our brand, are almost buying at the same price. Or the delta between our brand and their brand, which used to be very significant before our new capex, has reduced considerably. So that will continue to happen.
Right, sir. Right, sir. That's it from my side, sir. Thank you so much for answering all the questions.
Thank you, Mr. Bharat.
Thank you. The next question comes from the line of Mahesh Seth from VY Capital. Please go ahead.
ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्ड.
As there was no response from the last participant, the next participant is Manan Vandar from Walford PMS. Please go ahead.
Thank you so much for giving me the opportunity again. Sir, I just wanted to, I have a doubt. So, I just wanted to understand the realization per ton. So, for example, price when I see online for Keshav cement, it is showing around.
I'm sorry to interrupt you, Mr. Manan, but there is a lot of background disturbance from your line.
Hello. Now is it proper?
Somebody's talking, so can you please move to a different area?
Okay. Can you hear me now properly?
Yes, sir. It's better.
Is it better?
Please go
Yeah,
ahead.
okay. Just 1 second. Yes, yeah. Yes. So I just wanted to understand that when I see the realization per ton, okay, of Keshav cement, I wanted to understand because online I checked the prices. It is showing around 330 rupees per bag of 50 kgs. And then on the call in the start, I heard you say something 3,500 something for per ton. So I am not able to understand this because 50 kg is looking as 330 rupees, but for 1 ton in the start you said something around 3,500. So please can you explain that to me?
Yeah. So what I mentioned is the naked cement price, which is 3,460. Now this price is X our gate, which means that on this what adds is the taxes and the logistic cost. So I don't know where you got this price of 330, but typically the billing price are the ones which is given to the retailers. From that, there are discounts like price discounts, there are monsoon discount or payment discount and stuff like that. So, for example, I'll give a simple math. So 3,460 per bag, it is going to be looking like 173 rupees. At that time, it was 28% tax. So 173 rupees, but before tax, we also have to add the logistic cost, could be around 40 rupees. And on top of that, about 28% tax. So that takes it to 272 rupees. Plus, 50 to 20 to 30 rupees maybe a dealer margin or so. And typically cement bag printed price is around 300 to 330 rupees for them to sell, because from that again we have to give discounts to match the market. But I am not aware where you have taken that information, but it is roughly on the same lines we bill the customers.
Okay. So basically for us, that 330 rupees per bag should not be much. If I want to check, I will have to check naked cement price, correct? If you are looking at the company, yes, you have to look at naked cement price, because that is where everyone stands. Now, for example, if I sell the cement in about 10 kilometers away from my plant, the cost per bag or logistics is 5 rupees. Same thing if I sell it to Bangalore, the cost per bag is about 100 rupees. So how are you going to make an apple-to-apple comparison? Right. Okay, understood. And sir, second question is that last quarter, in the Concall, you said that around 25 crore PAT is possible. So what would be your comments on that, sir?
So basically, if you look at the PBT, now PAT is, now what is happening for our balance sheet particularly, PAT is, we have something called as deferred tax liability, which is actually not a cost or a tax expense which shows up on the balance sheet. It is purely because of Ind AS standards. So I would say PBT would be the almost the right way to look at it at this point in time.
Okay. So yes. So how can we see the PBT then, sir? How much?
Okay. So now for the first two, H1. So
yes.
You can hear me, right?
Yes.
Okay. I think the PBT for H1 is around, give me a minute. I'm just checking on. So around 4 crores is the PBT. Yeah, 4 crores is around the PBT. Now 25 crores we were expecting based on fact that the cement price would improve. In fact, cement price did show some improvement in at the time of call in for the last quarter.
Correct.
Around in August or so, but again, it quickly collapsed. I think July the price increased drastically, but again it quickly collapsed. So I'm hoping that third and fourth quarters are going to be better. Even though we may not be making a significant PBT, our cash profits are definitely improving.
Okay. So yet you could say that, because previously one participant asked you, saying that around 50 crores of EBITDA you are saying is possible.
This quarter, yes, 45 to 50, yes. assuming that our sales improves from this point onwards. Typically, 60% of the sales will come in H2. And in any case, the kiln has stabilized further in October. So yes, 45 to 60 is what we feel should happen, assuming that the market shows up in the way it is expected to show up.
Correct. And just one last thing, just a clarification from previous participant. One participant asked that if we do around 70% utilization in FY27, okay, so you said around 70 crore EBITDA you said. So if I take 7 lakh as the sales quantity, then are you saying that we can go to 1,000 EBITDA per ton because we are currently at 350?
See, currently we are doing 1,100 rupees EBITDA per ton if you look at including the solar power.
Correct.
So if you are doing 70%, it will, without any change itself, you will reach 70 crores. No, assuming that the cost of cement, the pricing of cement does not change, the fuel cost does not change. So it's just a simple math because then my fixed cost will virtually remain same.
Correct. So that means
right now, for example, So right now, about for the kind of sales that we have done, let's say for Q2, the EBITDA for this year has been around how much? I would say, this is 8.83 crores divided by 0.78,000. We have done 1,130 rupees EBITDA per metric ton. So for the 7 lakh tons, it should go up to 79 to 80 crores EBITDA, no?
Right. Okay. So that is how I have to understand and that is how I have to calculate. Okay.
Correct. That will be the safest way to look at it, no?
Understood. No, I was just thinking we also said around 350 rupees EBITDA per ton, no? So I was just confused because removing the solar.
I am segregating the solar EBITDA out of the system.
Correct. Removing the solar. Right. You're right.
Yeah. Because see, this year we did around 6.4 crore EBITDA on solar itself. But that I'm removing out of the remaining EBITDA what I'm generating, I am putting it on cement. Even though the energy used for cement itself.
Right.
But then that is an opportunity EBITDA which I would have otherwise also got.
Correct. Right, understood. Okay, that's it. Thank you so much. This was very helpful.
Sure.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next follow-up question comes from the line of Manan Vandur from Wallford PMS. Please go ahead.
Sorry, sir, I forgot to ask one more question. So in the south side, we see a lot of consolidation happening. Many, mergers and acquisition happening. So if we are, as you said that we have stabilized ourselves and in the future we start doing, stabilize EBITDA, etc. What do you think if someone comes to buy us out also?
To acquire us out, right?
Yeah.
It will be really building castles in the air at this point in time. But when any opportunity strikes, of course, the shareholders will be the first people to know about it. We will also know it at that point in time. There is a right price for everything and anything in the world. So if that happens, we will walk it with keeping in mind the shareholders' interest in mind.
Right. Just wanted to understand if, something like this comes up, if the management would be open to, take it up. That's all I wanted to know.
Yes, technically, yes. For that matter, anybody in the world will take it up for right price.
Correct. Yes. That's it. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Mr. Harshal Ghanshani for closing comments.
Thank you everyone for joining the conference call of Shri, Keshav Cements and Infra Limited. If you have any further queries, you can write us at research@kiranadvisors.com. Once again, thank you everyone for joining the conference call.
Thank you. Bye-bye.
On behalf of Kiran Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.